Brian, let's talk about diversification in a portfolio. First of all, define diversification.
Yeah, diversification is just not having all your eggs in one basket, basically. And I think most people would agree that makes sense. Sometimes it's a positive, and sometimes it's actually a negative, depending on what it is that you're in. You can be over-diversified, you can be under-diversified. So I just wanted to have some discussion around diversification.
So Brian, you talked about not having all your eggs in one basket. What is the disadvantage of not being diversified?
Yeah, the one thing that I want to talk about on diversification is you can be too diversified. So let's say you put down all the different asset classes and you want some of each. Well, I want some cash and some CDs and some money markets and some short-term bonds and mid-term bonds and long-term bonds, et cetera, et cetera. And by the time you get to the end of it, you don't really have much in things that can grow. Or let's say that you worked at Apple your whole career, or Microsoft, or some other company, and they've been doing great. And you're, I've heard this from stockbrokers all the time. Never have more than 5% in any one company. Well, you know, if you're working at Microsoft for your career and you kept your money in Microsoft, you're probably pretty happy you were non-diversified and you have all your money in Microsoft because you're probably a very rich person right now. So there are reasons to not be too diversified, but that could change over life. You might get to a point where, you know, I've done really well with Microsoft. I got $6 million of that stock. I'm going to sell 3 of it, put 3 in a diversified portfolio, not worry as much about the ups and downs of one stock, and the other 3 in Microsoft. Because I've also had the flip side of that. I used to have clients that, I had one lady in particular, and I talked to her about the importance of diversification. And she absolutely refused to change her investment. She had $4 million in the best company ever, pays a dividend every year. That company was Washington Mutual. She didn't sell any of it. Washington Mutual went to zero, and her $4 million went to zero, and she was 80 years old. I could not talk her into diversification. So there should be some, for most people, virtually all people, some measure of diversification, even if they love the stuff they're in.
Brian, is risk tolerance one of the benefits of being diversified in a portfolio?
Yeah, absolutely. And you know, we talk about these things. Things work until they don't. Enron worked until it didn't. Washington Mutual worked until it didn't. You know, there's all kinds of investments that worked until they didn't. So I think it's really important to have some measure of diversification. It doesn't have to be just the dartboard approach. There are, you know, some of the areas, there's a stock market, U.S., foreign, emerging, large cap, mid cap, small cap, you know, that's an area you can diversify in. There's bond diversification, all kinds of different bonds. There's government bonds, corporate bonds, short-term, long-term, high yield or junk bonds, all different kinds of bonds there. There's real estate, active, passive, private non-traded real estate investment trusts, Delaware statutory trusts with 1031 exchanges. There's insurance company products like fixed index annuities and fixed index universal life insurance. And then there's cash and cash equivalents, money market CDs, cash. All of these can add to diversification, but you may not want a whole lot of some of them. And so that's where you can start making these important distinctions and decisions when you're constructing your portfolio.
Brian, you talked about the lady who lost her money in Washington Mutual. Do you have an example of a client who has done maybe better or very well as a result of being more diversified?
Yeah, a couple examples. I remember early in my career, it was, I think, 1999. I had just gotten licensed, and this person came in real proud of themselves, and I said, "Are you diversified?" "Oh yeah, I'm diversified." "Well, what are you invested in?" And they proceeded to list every component of a computer and the software within the computers. You know, it was AOL, and it was all these different tech companies at the time. And he had a big margin loan on them because he knew that they were the future. He had $800,000 in them, and at the time. And I talked to him about 6 months later after the 9/11 dot-com crash, all of that, you know, a year later. And he says, "Yeah, my 800,000 dropped to 20 and I sold out. I lost 780,000 of my 800 because he wasn't diversified." They were great areas, and yeah, the computers were going to be great, but not at that time and not in those companies. And he wasn't diversified. Another example, had he instead taken that money and kept a bunch in tech stocks, that's fine, paid off the margin loan, had all the other areas I just talked about, we'd be talking about a whole different life going forward, a whole different retirement plan, just having watched this video and be thinking about diversification when you're non-diversified in certain areas.
Brian, thanks for that discussion about diversification. Very, very good.